Ever feel like you're just drowning in information? You wish there was a way to just cut through the noise and get to the real insights, not just, well, more facts. And we live in this age of data overload, right? But what we really crave is understanding. Today, we're taking a deep dive into a tool that's meant to give you exactly that, especially in the, let's face it, often chaotic world of finance.
Right.
It's the weighted moving average, or WMA. You hear it mentioned a lot. It's seen as this crucial way to quickly grasp market trends, but there's actually a whole lot more to its story.
Absolutely. And our mission today is really to unpack the WMA fully. We're going to trace it from its surprisingly old historical roots right through to how it's used in modern markets. So
Yeah.
dig into the math behind it, its unique strengths, yeah, but also its limitations and how it stacks up against, other similar methods. By the end of this, you should really get why it matters, whether you're actually analyzing financial markets, maybe trying to forecast sales for your business, or honestly just curious about how data gets filtered out there in the real world.
And trust us, this deep dive is packed with some really intriguing stuff. We're talking origins going way back to 18th century Japanese rice trading and this fascinating blend of serious academic statistics with actual market practice. Plus, this idea, which I find genuinely captivating, that the market might actually have a kind of short-term memory.
Okay, so let's start big picture. What's the fundamental idea behind moving averages, MAs, in general? It's all about smoothing out those little day-to-day price jumps and dips, right? To see the underlying trend more clearly gives you a better sense of where things are really going.
It's actually a remarkably old concept. I mean, picture this. 18th century Japan, rice merchants. Their whole livelihood depends on these market swings. They didn't have spreadsheets or computers, obviously, but they were already trying to find patterns. They used a kind of primitive moving average to try and predict where the market was heading next. It was like their earliest attempt to filter out the daily noise and spot the bigger picture, the real trend. That's amazing. Centuries before Wall Street as we know it. Then, okay, fast forward to the early 20th century. You often hear the name J.M. Hurst in finance circles, tied to technical analysis. But what's really interesting and maybe less known is the deeper academic connection for WMA itself.
Yeah, it's fascinating. We think of it as a trader's tool, but its roots are deep in rigorous statistical science. Forget the trading floor for a second. The concept of instantaneous averages, as he called them, was first calculated by a mathematician, R.H. Hooker, back in 1901. Then, in 1909, another statistician, G.U. Ewell, he described Hooker's work and actually coined the term weighted moving average. So this tells you it's not just some market hunch. It has a genuine scientific pedigree designed to pull signal from noise long before computers were even a thing.
Wow, okay, so it's grounded in actual mathematical principles, not just, something sketched on a napkin. And from these statistical beginnings, the MA concept really took off, didn't it? Leading to different versions like the exponential moving average, EMA, and our focus today, WMA, all trying to be more responsive. And you had figures like Charles Dow, fundamental to technical analysis, helping to popularize these kinds of tools.
Exactly. And that continuous development, from the basic simple moving average, the SMA, to weighted and exponential forms, it really reflects this ongoing quest in technical analysis. Finding that perfect balance. You need to filter out the random noise, right? Those short-term blips that don't mean much. But you also need a tool that reacts fast enough to catch genuine shifts in the market. And SMA, well, it's good for smoothing, but it lags. It's slow. WA tries to fix that lag by giving more weight to the recent data. The idea being, the newest info is probably more important for what happens next. EMA takes that even further, often reacting even faster. The fact that we have all these different MAs tells us there's no single perfect answer for every market or every trader. It reflects how complex markets are, how people keep trying to find an edge.
Right. So the practical takeaway here for you listening is that this early connection between academic statistics and actual market use gave WMA a kind of validity beyond just intuition. It's got some science behind it, not just a market feeling. So let's get down to it. At its core, what is the WMA actually trying to do for you? It smooths out price swings, yeah? But crucially, it gives you a more accurate picture of the trend by giving more importance, more weight to the very latest price points. And what that means for you is that it reacts faster to new price changes compared to a simple moving average.
And that responsiveness makes it incredibly versatile for you, whether you're an analyst or a trader. Let's look at its core uses. First, identifying market trends. If the WMA line is sloping up, that suggests an uptrend, sloping down, downtrend. And the steepness of that slope gives you a sense of the trend's strength. It can also act as dynamic support and resistance levels. They moved with the price. So in an uptrend, the WMA might act like a floor where prices tend to bounce off. And the opposite in a downtrend acting as a ceiling.
Okay, so you spot a trend using the WMA slope. How do traders then use it to decide, when to get in or out? Are there specific signals?
Yeah, that's where crossover signals are really common, and they can be quite effective. Think of it like this. When the asset's price actually crosses above the WMA line, that can be seen as a potential buy signal. Crosses below, maybe a sell signal. Another popular strategy uses two WMAs, a shorter-term one and a longer-term one. When the short-term WMA crosses above the long-term WMA, that's often called a golden cross, a bullish signal. The opposite, when the short crosses below the long, is a death cross, bearish signal. WMA can also help you figure out where to place your stop-loss orders, which is crucial for managing risk. And critically, it's almost always best used with other indicators, things like RSI, Menke-D, Bollinger Bands. They help filter out false signals. This holds true for stocks, forex, crypto, whatever you're trading. Some people even suggest it helps avoid bull traps, those nasty fake rallies.
One of the really intriguing things about WMA for me is how it implicitly challenges a big idea in finance, the efficient market hypothesis. By weighting recent data more heavily, WMA basically assumes the market does have a short-term memory, that past patterns, especially recent ones, actually matter for the near future. That's not just a technical detail, is it? It's a belief system. And if enough traders act on these WMA signals, could they become self-fulfilling prophecies?
That's a fascinating point. But it's also really important to add a note of caution here. WMA, used alone, can generate a lot of noise or false signals, especially when the market isn't trending strongly, when it's just chopping sideways. Its sensitivity becomes a drawback then. You get what traders call whipsaws. You get a buy signal, then immediately a sell signal, back and forth, racking up small losses. It's frustrating.
Yeah.
So confirming any WMA signal with other tools is absolutely crucial to try and avoid those traps.
That's a really vital distinction. And it's easy to get confused because you hear about different weighted averages. Just to be crystal clear if you're listening, when we talk standard WMA today, we mean weighting based purely on time order most recent gets most weight. If you're thinking about weighting based on trading volume, that's a different powerful tool called the volume weighted moving average, or VWMA. Important difference. We're focused on the standard time-weighted WMA here. Okay, so we know what WMA does, why it matters conceptually, but let's get into the mechanics. How does this actually translate into numbers? How is WMA calculated?
Right, the calculation itself. At its heart, WMA calculates an average of data points, usually closing prices over a set period. The key twist, compared to a simple average, is those different weights. Recent data gets the biggest weight, older data gets progressively smaller weights. Typically, it follows a simple linear pattern. So for instance, on a 20-day WMA, today's price gets a weight of 20, yesterday's gets 19, the day before 18, and so on, right down to a weight of 1 for the price 20 days ago.
Let's make that concrete. Say we want a 5-day WMA. And the prices from oldest to newest were 10, 11, 12, 13, and today's price is 14. A simple average would just be 10 plus 11 plus 12 plus 13 plus 14 divided by 5, which is 12. But the WMA calculation is different. It's 10, 1 plus 11, 2 plus 12, 3 plus 13, 4 plus 14, 5. You sum all that up, then you divide by the sum of the weights, which for 5 days is 1 plus 2 plus 3 plus 4 plus 5 equals 15. So that calculation, 10 plus 22 plus 36 plus 52 plus 70 is 190. 190 divided by 15 gives you about 12.67. See how today's price of 14 pulled that average up quite a bit compared to the simple average of 12? That's the weighting in action. It makes it more responsive.
Exactly. And that denominator, the sum of the weights, there's a neat formula for it, NN plus 1, 2, ensures it's a proper weighted average.
Yeah.
The normalized weights all add up to 1. It gives it that mathematical consistency. So WMA kind of strikes this balance, doesn't it? It's simpler to calculate than, say, an EMA, but definitely more responsive than a basic SMA.
Okay, makes sense. Now, every model, every indicator rests on certain assumptions, right? Even what, like WMA, what are the fundamental ideas baked into it?
Well, the most basic assumption, true for most moving averages, is that the time series, the price data you're looking at, is locally stationary. That just means its average level changes relatively slowly over time. It's not completely random second to second. But the core assumption that's really unique to WMA is that more recent data points have a greater impact on near-future price movements. That directly ties back to that short-term memory idea we mentioned. It assumes the immediate past matters more than the distant past. And it's interesting to contrast WMA with more, let's say, statistically pure models. Many academic models assume things like independent and identically distributed data, basically, that each price change is random and drawn from the same statistical hat. Or they might assume conditional homoscedasticity, which is a fancy way of saying market volatility stays constant. But anyone who watches markets knows that's often not true. Markets have calm periods and wild periods, volatility changes. WMA sort of sidesteps these strict statistical assumptions.
It feels more like a practical empirical tool that grew out of observing how prices actually behave, rather than being derived purely from theory.
This sounds really effective for spotting trends, but is WMA equally useful in all market conditions, or are there specific environments where it really shines and maybe others where it struggles?
That's a critical point.
Okay.
WMA works best. It truly shines in markets that are clearly trending either up or down. Makes sense, right? Its responsiveness helps you catch and ride that trend. Where it really struggles is in sideways, choppy, or range-bound markets. And understanding why is key. When there's no clear direction, that sensitivity we talked about becomes a problem. It starts reacting to every little random wiggle in price. This leads to those whipsaws, again, lots of false buy and sell signals that can quickly eat away at your capital if you act on them. So it really underscores the need to identify the current market context before you even think about applying WMA. Is it trending or ranging? That determines if WMA is likely to help or hinder you. It helps interpret market behavior, crowd psychology perhaps, maybe even leading to those self-fulfilling effects rather than being some kind of mathematically perfect predictor.
Okay, so context is key. Now, what about the practicalities? What kind of data do you actually need to feed into a WMA calculation? And what are the main adjustments, the sort of knobs you can turn to customize it?
The basic input is just a time series of prices for whatever asset you're looking at. Most commonly, people use the closing price each day or each hour or whatever time frame you're using. But you're not strictly limited to the close. You could use the opening price, the highs, the low, or even an average price for the period, like high plus low too. The absolutely critical thing is that the data has to be accurate and properly ordered by time. Garbage in, garbage out applies here just like anywhere else. Data quality completeness, accuracy is paramount. An interesting technique some people use is plotting multiple WMAs using different price points, like one on the high and one on the low. That can sometimes create a kind of dynamic support or resistance zone on the chart. And because it uses a sliding window, always looking at the most recent end periods, it's inherently well suited for real-time data analysis.
Right. And you mentioned end periods. That sounds like the most important parameter, the biggest knob you can turn, the length or number of periods. What happens when you change that length?
Exactly. The length N is the primary parameter you'll adjust. And the choice has a big impact. A short-term WMA, let's say using 5 to maybe 26 periods, is going to be highly reactive. It hugs the price action closely. That makes it good for catching trends or reversals very quickly. But, and this is the trade-off, it's much more prone to generating false signals, especially if the market is volatile or moving sideways. Day traders often lean through these shorter lengths. On the other hand, a long-term WMA, maybe 50 periods, 100, even 200 periods, is going to be much smoother. It filters out more noise. It's better for identifying those major long-term trends. But the downside is more lag. It will be slower to react to changes in direction. Trend followers often prefer these longer lengths. Now, how do you tune the length? Well, there's no single magic number. It really depends on your trading style, your risk tolerance, the specific asset you're analyzing, and the current market environment. You can test different lengths on historical data that's called backtesting, but you have to be really careful about over-optimization or curve fitting.
Curve fitting, that's where you make it look perfect on past data, but it falls apart going forward.
Precisely. It fits the past noise instead of the underlying pattern. That's why it's crucial to test on out-of-sample data the system hasn't seen during the optimization process. You can also just visually observe how different lengths track the price on a chart, or try to align the length with known market cycles, though that's more subjective. There are other less common parameters too, like displacement, which just shifts the WMA forward or backward on the chart. And in some very specialized systems, like SAP's IBP for planning, you might even have an external source of weights, showing the broader statistical concept behind weighted averages.
So what this means for you is that tuning the WMA isn't really about finding some secret perfect number. It's more about aligning the tool's behavior with your specific way of looking at the market, your time frame, and how much fluctuation you're comfortable with.
Absolutely. And that whole challenge of finding the right length and the risk of overfitting to past data, that actually leads into a more advanced area, adaptive moving averages or AMAs. These are indicators designed to automatically adjust their own sensitivity, their own effective length, based on how volatile the market is right now. It's a potential future direction trying to make MAs smarter.
Okay, interesting. So once you've set up your WMA, maybe combined it with other tools, how do you actually measure if it's performing well for you? How do you quantify its success?
Yeah, good question. We generally look at performance in two main ways, depending on how you're using the WMA. First, if you're using it purely as a forecasting tool, trying to predict the next price, you'd use statistical error metrics. things like mean absolute percentage error, MAPE, mean squared error, MSE, or root mean squared error, RMSE. Lower numbers are better, indicating the WMA is tracking the price more closely. Second, and probably more common for traders, is evaluating WMA as part of a complete trading strategy. Here, the metrics are different. You'd look at things like win rate, what percentage of trades are profitable, average win versus average loss ratio, profit factor, total winnings divided by total losses. You want this above 1. And crucially, risk metrics. Maximum drawdowns is the big one. What's the biggest peak to trough drop your account might experience? That tells you about risk. And then risk-adjusted returns, like the Sharpe ratio or the Sortino ratio. The Sharpe rate ratio measures return relative to overall volatility. Sortino focuses only on downside volatility. For Sharpe, generally above 1 is considered good, 2 is very good, 3 is excellent.
Got it. So beyond the performance numbers, just recapping its inherent behavior, how does WMA feel compared to its relatives SMA and EMA? What are the key behavioral traits?
Okay, summing that up, WMA is generally more responsive and has less lag than the simple moving average, SMA. That's its main advantage over SMA. Compared to the exponential moving average, EMA, WMA is usually less responsive. EMA tends to be the fastest of the three, so WMA often provides better signal clarity than SMA when a strong trend is in place because it tracks closer. However, because it is more sensitive than SMA, it can generate more false signals, more whipsaws, especially in non-trending markets. It really boils down to that constant trade-off in technical analysis. Speed versus smoothness, responsiveness versus noise reduction. WMA sits somewhere in the middle ground between SMA and EMA on that spectrum.
Okay, that comparison is really helpful. Let's dive a bit deeper into that. WMA versus SMA and WMA versus EMA. Can you crystallize the key distinctions so someone listening can make a more informed choice?
Sure. Let's take WMA versus SMA first. The absolute core difference is weighting. SMA gives equal weight to every single data point in its calculation period. Price from 10 days ago matters just as much as yesterday's price. This makes SMA smooth, good for identifying long-established trends, but it introduces significant lag. It's slow to turn when the trend changes. WMA, as we've detailed, gives linearly increasing weight to more recent data. Yesterday's price matters more than the price from 10 days ago. This makes WMA faster, less laggy than SMA, good for catching trend changes earlier. But the trade-off is it can be choppier, more sensitive to short-term noise, leading to potentially more false signals. So, very generally, SMA might be better for long-term trend following. WMA often preferred for short to medium-term analysis where a faster reaction is needed.
Okay, that's clear. Now, how about WMA versus EMA? They both prioritize recent data, so what's the difference there? Is it just how they do the weighting?
Pretty much. Both WMA and EMA aim to reduce lag compared to SMA by emphasizing recent prices. The how is different. WMA uses that linear weighting scheme we described, weights like 1, 2, 3, 4, 5. EMA uses exponential weighting. This means the weight assigned to older data points decreases exponentially, not linearly. In practice, this gives even more importance to the very latest data points compared to WMA. As a result, EMA is generally the fastest, most responsive, and has the least lag of the three main types. But, you guessed it, that also means it can be the noisiest, the most prone to reacting to insignificant price fluctuations and giving false signals. WMA often sits in a nice middle ground trying to balance the smoothness of SMA with the sensitivity of EMA. It's also worth noting EMA's calculation formula is slightly more complex, involving the previous EMA value. And remember that study about smoothing effectiveness measured by MSE. In that specific test, EMA and SMA actually scored better than WMA. But again, low smoothing error doesn't automatically mean higher trading profits. Context matters. Oh, and one more clarification. You sometimes see LWMA, linear weighted moving average. For all practical purposes, that's usually just another name for the standard WMA we're discussing.
This is fascinating. So it really drives home the point. There is no single best moving average. It's not like one is definitively superior. Your choice really depends entirely on what you're trying to achieve, your trading style, your time frame, and the specific market conditions you're looking at right now. It's a strategic choice, isn't it? Balancing that need for speed against the need for reliable signals.
Exactly. And the fact that analysts and traders are still developing new types of moving averages, you hear about the Hall MA, the volume-weighted MA we mentioned, adaptive MAs. It just highlights how complex financial markets are. They're constantly changing, evolving. It means for you, as someone trying to understand these tools, the learning never really stops. You need to keep updating your knowledge as new approaches emerge.
Okay, so bringing it all together, let's talk scenarios. When does WMA really perform well, and when is it likely to let you down? Where does it shine, and where does it struggle?
Right.
WMA works particularly well and really shines in strong, clearly defined trending markets. Doesn't matter if it's an uptrend or a downtrend. Its relatively fast reaction time helps you identify those trends early and potentially ride them. It's also often favored for short-term to medium-term trading styles. Think day trading or swing trading, where reacting quickly to price changes is really important. And, as we've stressed, its reliability goes way up when it's combined with other confirmation indicators. Using RSI to check momentum, MCD for trend confirmation, Bollinger Bands for volatility, maybe volume analysis or candlestick patterns, or even just basic static support and resistance levels. Don't use it in the vacuum.
Okay, those are the good conditions. What about the bad ones? When should you be wary of relying on WMA?
WMA performs poorly and can actually be detrimental in sideways or ranging markets. When prices are just bouncing around without a clear direction, its sensitivity leads to those constant false signals, the whipsaws, which can bleed your account through small losses and commissions. Similarly, it struggles in choppy, highly volatile markets that lack a clear underlying trend. It just overreacts to all the random noise. Using it in isolation without any other confirmation tools or a solid risk management plan is generally a bad idea. Obviously, if you choose the wrong length and for the specific asset or time frame you're trading, its signals won't be very useful. A 200-period WMA on a 5-minute chart probably doesn't make much sense. And finally, like pretty much all technical indicators, WMA can break down during major unexpected news events or black swan moments. When fundamental news completely overrides the technical picture, past price patterns become irrelevant, at least temporarily.
So the big takeaway here seems to be that WMA's effectiveness is incredibly context dependent. You absolutely need to be able to recognize the current market personality. Is it trending, ranging, choppy, before you can use WMA effectively? Now, we focus heavily on finance and trading, which is where WMA is most famous. But where else do we see its core principles weighting recent data more heavily applied out there in the real world?
Yeah, while finance and trading are definitely its primary playground stocks, Forex, crypto, using it for trend ID, signals, dynamic support resistance like we discussed.
Yeah.
Think buying a stock when its price pops above a rising 20-day WMA, maybe setting your stop loss just below that WMA line. That's classic stuff. But the underlying concept is much broader. In economic and business forecasting, companies often use WMA principles. For sales forecasting, weighting recent sales figures more heavily can give a better reflection of the current trend. Same for inventory management. Using recent demand data helps optimize stock levels. Economists might use it too to smooth out and analyze noisy macroeconomic indicators like monthly inflation figures or GDP growth rates, trying to see the underlying trend more clearly.
Interesting. So business forecasting, economics, does it stretch even further? Any more unexpected applications?
Conceptually, yes. Think about weather forecasting. Meteorologists inherently prioritize recent observations, current temperature, pressure, wind, much more heavily than data from a week ago when making short-term predictions. That's the WMA principle in action. Even in fields like healthcare, the concept of weighted time series analysis appears. For instance, there's research using deep learning models to detect heart conditions like wall motion abnormalities from ECG signals. In those models, the recent electrical activity of the heart is often given more weight because it's more indicative of the current state. The acronym WMA might mean something different there, but the principle of weighting recent temporal data is similar.
Fascinating. So the core idea really resonates. The recent past is often treated as a better guide to the near future than the distant past.
Exactly. And when you look at the actual results of using WMA strategies in finance, well, they're highly varied, as you might expect. Some academic studies have shown that moving average strategies, including WMA variations, can potentially outperform a simple buy and hold strategy, but usually only in specific market conditions, maybe in less efficient markets, or during particular phases of a company's life cycle. There's even research on moving average ratios, suggesting they might have some predictive power for stock returns, perhaps because investors tend to underreact to new information initially. And some studies on Forex markets show that strategies based on MA rules can achieve profitability, although they're often very sensitive to trading costs like spreads and commissions.
Right. So this is absolutely crucial for you listening. While backtesting software can easily show you impressive historical results for a WMA-based strategy, you have to remember that past performance is never a guarantee of future results. Say it again. Past performance is not indicative of future returns. Real success seems to depend heavily on selecting the right parameters, crucially combining WMA with other confirming indicators, implementing really robust risk management stop losses, take profits are essential, and maybe most importantly, being willing to adapt your strategy as market conditions inevitably change. Okay, so after this comprehensive deep dive, let's talk practical optimization. How can someone listening best use WMA to their advantage, and what might be next for this tool? What's on the horizon?
Right, optimizing WMA usage. First and foremost, choose the right length, and you need to tailor it. Adjust N based on your trading time frame, shorter for faster action, longer for smoother trends. Consider the typical volatility and behavior of the specific asset you're trading. And factor in the current market conditions, maybe use a shorter length in a strong trend, longer in a developing one, and always backtest responsibly, using out-of-sample data to guard against that dangerous over-optimization we talked about. Second, and we can't stress this enough, combine WMA with other indicators. Please don't use it in isolation. Confirm its signals. Use RSI, MAD, Bollinger Bands, look at volume, analyze candlestick patterns, identify key static support and resistance levels on your chart, build a confluence of signals.
It sounds like using just one WMA might be limiting. What about layering them or looking across different time frames? Does that provide a richer picture?
Absolutely, that's a key optimization technique. Relying on a single WMA often doesn't capture the full story, so yes, use multiple WMAs. Implement crossover strategies, like we mentioned, maybe a 20-period WMA crossing above or below a 50-period WMA. This helps confirm trend changes. Or use multi-time frame analysis. For example, look at a long-term WMA, like a 200 period, on a daily chart to determine the overall dominant trend. Then drop down to an hourly chart and use a shorter-term WMA, like a 20 period, to find specific entry or exit points in the direction of that main trend. And underpinning all of this, apply strict risk management. This is non-negotiable. Always define your risk before entering a trade. Set stop-loss orders to limit potential losses if the market moves against you. Set take-profit levels to lock in gains. WMA itself can sometimes help you determine logical places for these orders, maybe just below a rising WMA for a stop-loss in an uptrend. Finally, you have to adapt to market changes. Financial markets aren't static. What worked last month might not work next month. Be prepared to monitor your strategy's performance and adjust your approach or your WMA parameters as market conditions shift from trending to ranging or volatility changes.
So it really reinforces that this isn't about finding one magic number or a secret setting. It's about cultivating a deep understanding of how WMA interacts with price, how it behaves in different markets, and then integrating it intelligently into a broader, well-managed trading system.
Exactly. And looking ahead, what's next for research and development around WMA? Well, a few interesting areas. One is definitely adaptive WMAs, trying to create versions that automatically adjust their own length or even their weighting scheme based on real-time market conditions like volatility or trend strength. Moving beyond a fixed N, another area is exploring novel weighting schemes. Could we use nonlinear weighting? Or maybe incorporate other factors directly into the weighting, perhaps like trading volume, going beyond just time order, creating hybrids. And of course, the big one, combining WMA with machine learning and AI. Could algorithms learn to dynamically optimize WMA parameters in real time? Or identify more complex, subtle trading rules based on patterns in WMA signals that humans might miss? That's a very active area of research.
Wow. So we've really journeyed deep into the weighted moving average today. We've unraveled its surprising history, gotten into the nuts and bolts of its mechanics, and explored its practical power and its limitations. You've seen how it prioritizes recent information, trying to capture that elusive short-term memory of the market, and how it constantly seeks that balance between speed and smoothness.
And, this exploration of WMA, it isn't just about finance charts. It's really a window into this fundamental human challenge. How do we make sense of complex, noisy, ever-changing systems? So as you navigate your own world, your own information landscape, maybe ask yourself, where might you find hidden weights factors that are influencing outcomes more than you initially realize? And how can understanding the fundamental trade-offs inherent in any decision-making tool, that trade-off between, say, speed versus smoothness we saw with WMA, how can understanding those trade-offs empower you to make more informed choices, not just in markets, but in any complex decision you face?